All right, let's just get right into it. Think about it for a second. In almost every high-stakes field out there, sports, surgery, construction, you always start with a plan, a blueprint, a strategy. But for some reason, when it comes to the stock market, where our actual hard-earned money is on the line, so many of us just jump in blind. Today, we're going to break down why having a solid trading plan isn't just a nice little idea, it's pretty much the only way to even play the game.
So let me just ask you this. Think back to the last time you bought something kind of pricey, like a new TV or a laptop. I bet you spent hours, maybe even days, reading all the reviews, comparing the specs, hunting down the best price. Now, be honest with yourself. Do you put that same amount of effort into buying a stock?
And this quote just hits the nail on the head, doesn't it? It's such a weird but incredibly common thing we do. We hear a hot tip, we see some chatter online, and boom, driven by a little bit of greed and FOMO, thousands of dollars are thrown at something with basically zero due diligence. It's just a recipe for disaster.
Which brings us right to our first big point. Trading without a plan isn't really trading, it's just a fancier way of gambling. Now, you might start out with something that sounds logical, right? Like the classic, buy low, sell high. But you are going to find out very, very quickly that the market is way more complicated than that simple little phrase. A classic beginner mistake is buying a huge household name company after its stock has taken a hit, thinking, oh, it's a safe bet. But here's the thing, and the source material makes a fantastic point here. There's really no such thing as a safe stock. That's kind of like saying there's a safe race car. By their very nature, they all come with risk. And if you need proof, just look at General Electric. I mean, this was one of the biggest, highest quality blue chip companies on the planet. But from its peak back in 2000, the stock got absolutely annihilated, losing over 90% of its value. 16 years later, people who bought at the top were still down 50%. So much for being safe, right? Okay, so if we can't just rely on old sayings or a company's big name, what's the answer? Well, it's creating your own trading playbook, a concrete, written-down set of rules that governs every single move you make in the market. No exceptions. So what exactly is a trading plan? Well, think of it as your personal rule book. It lays out the what, the why, the when, and the how for all of your trades. And listen, the point isn't to guarantee you win every single time. That's impossible. The point is to manage your risk and, this is so important, to give you a way to know if your strategy is actually working or not. And any decent plan is going to have a few non-negotiable parts. You need a crystal clear trigger for when you buy. You need a rock-solid plan for what you do if the trade goes against you. You need a strategy for taking profits when you're right. And you absolutely need rules for how much of your money you're going to risk on any one idea. Let's just be super clear about this. Buying a stock and just hoping it goes up, that's not a strategy. That's wishing. That's a lottery ticket. A real plan replaces that fuzzy hope with a clear process and with measurable expectations. I absolutely love this analogy. Think of your plan like it's a train schedule. So if the 6:05 train isn't there at 6:15, okay, it's a little delayed, no big deal. But if it's still not there by 7:30, you know something is seriously wrong and you need to find another way home. A plan does the exact same thing for your trade. It tells you if things are on track or if it's time to get off. Okay, let's take this a step further. A truly professional approach goes beyond just the initial plan. It's about building in contingencies, thinking through every possible what-if scenario before you even click the buy button. That way, you're ready for anything the market throws at you. Your contingency playbook has to be detailed. You need to know in advance the exact price where you will get out and take a loss, period. You need rules for when to sell into a big rally to lock in those gains, and when to sell into weakness to protect the profit you've already made. And yeah, you even need a disaster plan for those crazy, unexpected, market-crashing events. And as a trade unfolds, your priorities actually change. Right at the beginning, your number one most important job is to limit your loss. Then, once the stock starts moving your way, your priority shifts to protecting your entry point, getting to break even. And then, once you've got a nice gain, your whole mission changes again to protecting that profit. All right, so you've got a plan, you're in a trade, now what? Well, the next step is knowing how to read the signs in real time. You've got to figure out if the trade is behaving like a winner, or if it's starting to show signs of trouble. This is maybe my favorite analogy of the bunch. You want to own stocks that act like tennis balls, not eggs. When a really healthy stock pulls back, it's short, it's sharp, and it bounces right back to new highs. An egg, on the other hand, well, it just goes splat. It breaks down and it never recovers. Learning to see that difference it's a game changer.
Now, here's a more specific tool for you, the MVP indicator. It's a really simple way to spot signs of strong institutional buying. If you see a stock with this kind of powerful momentum, volume, and price action over a 3-week period, that is a massive clue that the big money is getting behind this move.
Now, just as important as seeing the good signs is recognizing the bad ones. These are red flags, violations that tell you a trade is probably not working out. We're talking about things like a breakout on really low volume that gets slammed back down on huge volume, or closing below a key level like the 20-day moving average right after it breaks out. The more of these violations you see, the higher the odds that the trade is going to fail. And this all leads us to the final and maybe the most important piece of this entire puzzle, the psychological edge. See, a plan isn't just a technical tool for your charts. It's a mental tool that helps you conquer the two emotions that sabotage almost every trader: fear and greed. Because without a plan, traders get stuck in this awful, vicious cycle. In the moment, they are paralyzed by indecision. Should I buy? Should I sell? And then, in hindsight, they're just crippled by regret. I should have bought, I should have sold. A plan shatters this cycle because it forces you to make those decisions ahead of time using logic, not raw emotion. And here's the bottom line, the crucial takeaway. A plan frees you up to operate in the now. It lets you see the market objectively, for exactly what it is, not worse than it is because you're scared, and not better than it is because you're greedy. You stop reacting emotionally, and you just start executing your plan. And this quote from the trading legend Ed Sikota just sums it all up so perfectly. A good plan helps you tell the difference between a real gut feeling that's based on experience, that's intuition, and the very dangerous act of just wishing for something to happen. At the end of the day, your success isn't going to depend on finding the one perfect stock. It's going to depend on developing a sound process and having the discipline to stick to it, day in and day out. And all of that starts with a plan. So, the only question left is, what's in yours?